Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have with us here this morning centre-back Nick in Newcastle, and who is also in Canada, I believe. Good morning to you both.
Good morning.
We have three subjects for you this morning. We're going to touch on an interesting, actually more than interesting, I would call it a fascinating pharmaceutical company that Graham has uncovered and been following for probably about getting on for close to 3 years now, Graham. No official recommendation, a stunning story. We'll get into that first. Then we're going to talk about, with Nick, the GYG buyback, the Guzman y Gomez buyback, which is causing some consternation. We've got some strong opinions about that. And finally, we're going to talk about some of the sectors that we feel have suffered and are attractively priced as a result of the threat of AI disruption. Let's kick things off with Telix. Telix Pharma, Graham. Tell us about this company and why you are quite excited about it.
Yeah, it really is one of those companies that I really enjoy researching because it just shows you how far medicine has come over the past decade, let alone over the past 30, 40 years. So Telix is a radiopharmaceutical maker for cancer. And at the moment, its main product is one that is used to trace and outline cancers in PET scans. But it uses a very interesting way of doing that, which is it attaches the radioactive isotopes to antibodies, which then seek out the cancer, and then they can image it much more clearly. It's a very accurate imaging tracer compound versus other ones that are out there. So it was released a few years ago, and it's absolutely shot up in popularity. So it went from basically a standing start to $300 million of revenue for the first 6 months of the year, which is about 30% of the market for imaging tracers for prostate cancer. And yeah, management thinks it can get to kind of 40, 50%. It's already at least halfway there, but it's just been a very, very impressive rise for quite a unique and interesting company, even though it's only got one product, two products at the moment. So it's also has its own set of risks. But yeah, on that front, it's quite interesting.
So you call this, this really targets antibodies in our blood, and you called antibodies the James Bonds of our immune system. So what they're doing is they're looking around and targeting pathogens, and when they find one, they latch onto it and kind of tag it so that other parts of the immune system can destroy it. And what this company produces is a radioactive molecule that does a tagging of sorts of its own that allows the immune system to then destroy those cells. Is that interpretation correct?
Well, it's attaching those radioactive molecules so that the imaging devices can see the cancer. It isn't a therapy itself. It's just allowing the radiologist to actually see the cancer more clearly, and then they can act on it with either surgeries or other therapies and that sort of thing. Okay. But yeah, the basic principle is right. It's attaching these radioactive molecules to the antibodies and letting the antibodies do the heavy lifting by seeking out the cancer, and then they attach to the cancer looking for specific proteins on the cancer cells.
Okay. Now, why haven't we got an official recommendation on this? Because I went back and looked through the history of this company back to early 2023, I think it was, when this drug was first getting started, really. I think back then the share price was about $7. It's currently about $14, but it's been all the way up to $30. So it's had its boost of enthusiasm. Why are you so? Why haven't we got a formal recommendation on this?
Well, unfortunately, it does fall into the category that a lot of value investors tend to miss, which is it's a very high risk company, and so we're usually looking at the downside, and there just are so many risks surrounding it, which we can get to in a minute. But you tend to overlook. I mean, if a company has, particularly these research-based companies, they might have a 1 in 10 chance of succeeding or something like that. And that makes them very difficult to invest in early on when there aren't other drugs that they can rely on. So there's a difference between this sort of company where all of its eggs are in one basket. If if its main drug fails or if it doesn't take market share, then that's it. It doesn't have anything else to rest on. Whereas something like CSL, it's got a very diversified portfolio of drugs. If one of its research candidates doesn't work out, then they can lean on the existing revenue from the other things. So they're much, much more stable, which is why, when we work down the rankings of is this a strong buy or a speculative buy, or is it not even on the Ideas Lab kind of scorecard, then, unfortunately, Telix doesn't really get all that high up. Its risks are just too significant. But having said that, it's quite a different company to what we looked at a few years ago. It has now 2 products that have been approved by the FDA in the US. It also just recently got a special type of approval for its second drug called Guzelex. So one of the issues that even if you get approved by the FDA, it's kind of hard to sell to hospitals and distributors because of different rules around how they can price their products. And it recently, I won't go into the details for this one, but recently its second product just got an expanded approval, essentially, which means hospitals are now able to basically bill the company separately at the full cost of the medicine or of the drug. And that just makes it easier for them to actually buy it. They don't have to group its pricing in with other services. So we would expect Guzelex to do quite well, even as Illuccix kind of loses that pricing advantage because its special treatment by Medicare is starting to roll off.
Okay, so let's talk about the revenue growth then, because it's been cracking along at an incredible pace, isn't it?
Yeah, it's literally gone from a standing start to call it 700 million or so in just three or 4 years. And it's now it's recently been approved for its main drug Illuccix in the UK, in Australia, in Canada, in parts of Europe. And at the moment, most of the revenue, almost all of it, is coming from the US. So as it starts to sell to these other countries, you'd expect that revenue will continue to grow. It won't be as good on the pricing level as in the US. The US typically has much stronger pricing than overseas, but there's still kind of all of the levers are there to grow revenue at least 15, 20% a year for at least maybe 5 years or so.
And it's got approval, so Illuccix, is that the right way of saying it, Illuccix?
I hope so. That's how I've been saying it.
Nick, do you want to have a go?
No. There's too many L's, too many C's.
There is. So it's now in 19 European markets. They came out with their result last night. Unaudited revenue of about 206 million for the third quarter, up 53% year over year. That's down to primarily Illuccix and its growing market acceptance by the sound of it.
Yeah, and also some of that revenue growth will be from a recent acquisition. In January, it bought a company called RLS Radiopharmacies, which are basically specialist pharmacies in the US, about 30 of them, which make these nuclear medicines. So one of the issues with the product that Telix sells is that it has an expiry of just a few hours. If you're buying other drugs on the pharmacy shelves, they might be sitting there for weeks or months and sometimes years. But Telix's products, they are gone by the end of the day. So you need to be very, very well set up in manufacturing and distribution. And this recent purchase of RLS, they bought it for 230 million or so. That I think is actually the part of these first 6 months that's most interesting, because although these pharmacies don't make any money, they probably lose money for the company. They do give it a little bit of a moat advantage in that they can manufacture their medicines more efficiently. They can get them to kind of 85% of the population in the US within hours. And that maybe gives the hospitals more confidence they can deal with these drugs. And so combined with that kind of Medicare advantage we talked about earlier, those two things I think set up Telix pretty well for in the US at the moment. Okay,
so the stock price rose up to $31. That's a tenfold increase in about 5 years. It's down about 50% since May. Why did the stock price fall so much so quickly?
Well, it fell for a few different reasons. Mr. Trump doesn't make life easier for any pharmaceutical company at the moment. But on top of that, they had one of their main research candidates called Pixclara, and again, a crazy name choice, whoever's there in the marketing office. But anyway, this was
they're
a brain
designed to
imaging.
be misunderstood. I think these, like it's like
gotta
greetings
wonder.
cards. There's a certain kind of person who writes little things inside greetings cards, and it's the same. It's the same for bloody pharmaceutical drugs.
Yeah, it is. It's very strange. They're either overdosing on vowels or they're kind of putting all kinds of weird letters next to each other. In any case, one of their main drugs, which was for brain imaging, another tracing agent, it was under FDA's in its approval process. So it's actually done all of its clinical trials at the moment, and it was waiting for approval by the FDA. But the FDA came out and said that it doesn't have any safety issues, but they want some more evidence that it actually works. And that probably doesn't send it back to square one, but it means that the company will now have to go back to its trials, maybe run some extra ones or go through the data and reshape it so it satisfies the FDA. That can take maybe a year. So essentially their best hope for a third drug on the market is kind of hit a snag.
Okay. That's to be expected, though. I imagine only about 1 in 10 drugs that go through the three stages of clinical trials actually get approved. It's a hit and miss kind of business, isn't it?
Yeah, I think you've got to roll with it. Even these kind of things, some pushback from the FDA, that's not unusual. It's not pleasant, but it's not they would have been prepared for this, and they'll get to it. It would have been nice if their first application was approved, but this isn't some sort of deal breaker or anything like that. So we'll see how it goes.
Okay. The only thing I can tell you about the naming of pharmaceutical products is if it ends in MAB, that means it's a monoclonal antibody. That's the full extent of my knowledge of these things. Okay, so that's Telix Pharmaceuticals, targeted cancer imaging and therapy. It's really growing very quickly, and you described it as an underpriced lottery ticket ? The question mark explains why.
There's a lot of question marks.
Formal recommendation, but for people listening, I think it's worth looking at this company because it's the two drugs that are on the market now seem to be quite interesting, are growing quickly, and that means the pipeline is not as big a punt as these kind of businesses often are in their earlier stages. This has proven itself to be a market that is capable of growing in, and that's kind of like the last hurdle. Whether it's worth $7 a share, I don't know. That's Graham's job, but that's a fascinating company. Thanks for that, Graham. Let's now talk about I'm trying to think of tacos and burritos and stuff like that. Guzman y Gomez, Nick, what's going on there? They had a strange, it seemed to me to be very strange, $100 million buyback was announced last week, I think, for a company that's got a market capitalization way above 100 million. What was the point of it? Why were they doing it?
Well, your guess is as good as mine. I've got no idea. It's a really strange decision. So a year ago, Guzman y Gomez sold stock. Came public at $22. So the pre-IPO shareholders, I think, sold down like $350 million. But a year on from that, they now want to buy back that stock. So, $100 million of the money they raised is now going to be used to buy back stock at $25 a share. So at a premium to what they sold it at last year. It's a really strange decision. I mean, buybacks in Australia are quite rare because we favour dividends because of their tax advantages. So you only really want a company to ever do it if they think their share price is grossly mispriced. And what's really baffling to me is I don't know how management have came to the conclusion that a year on from their IPO and with the progress of the business too over the last year, that Guzman y Gomez shares are dramatically mispriced at the current price. It's really weird, and it sort of it raises questions. Is this a potential phantom buyback, which is where a company just announces a buyback but has no intentions of to buy back any stock? It's pretty much to support the share price, and the reason I think that is because or the reason I think that could be the case, it obviously might not be, is that the pre-IPO shareholders are now out of escrow. So they came out of escrow after the company released their...
Do you want to explain what escrow means?
Yeah, it's essentially... it's a thing to... a little thing to encourage people investing in the IPO and giving them the confidence that the stockholders that are already there won't rush out and sell their shares. So the escrow means that they are restricted from doing so for a certain period of time. So in Guzman y Gomez's case, it was after the release of their FY25 results. And that means that any shareholder pre-IPO can now sell their shares freely on the market. So, it raises the question whether this was just is a tactic to sort of prop up the share price.
Well, it doesn't even prop up the share price in a practical sense, because $100 million buyback for a company, I don't know what the market cap is, but what is it, 2.5 billion?
Yeah, about 2.5 billion.
It's a nothing amount of stock.
Well, I think it's more the signal it gives.
Yeah, that's right.
Yeah,
that's what it is.
It's not. And why I say a phantom share buyback is micro cap land and small cap land, companies do this quite regularly, and they don't actually buy back shares. Whether that's the case here, like I've got no idea, but we'll find out pretty soon. So the buyback is due to commence on the 24th of October. And if they're just, buying back a few shares each day or not buying back anything at all, maybe it suggests it is a bit of a phantom buyback. But we'll find out.
I think that word that you said, signalling, is probably the key word there. Is this a company saying to potential investors, we think we're cheap, so you should come in and buy some too?
Yeah, like I think it potentially is, but my problem with that is it trades at over 100 times earnings, so the valuation, doesn't really suggest it's that cheap, and that valuation will probably fall quickly as they roll out stores. And this is a company I actually like. It just has, the valuation is a bit high. I mean, the model and what they've done here, should be applauded. I mean, this is a business now with 240 stores in Australia. They've filled a gap in the market with that sort of healthy, fast casual cuisine. The store model is very efficient, so you can roll it out in like a standalone drive-through location or a shopping centre or a strip mall. You can sell the store to franchisees or operate them as the corporate. And now that they've introduced breakfast, there's a chance to really, grow their average unit sales as well, because they'll have 3 day parts. So, you sort of have to applaud management. It's just the valuation is quite high, and there's a few other little things they do with like how they present some of their sort of, key performance metrics. And so like their restaurant margin is presented without taking into account the interest portion of leases, and so is their franchisee median return on investment figure that they release as well. And leases for a business like this, and the interest portion of those leases are real costs. So there's a few things there, but this is a business I'd really like to own at the right price. But there's just a few things, and management's decision here, like to roll out this buyback at a price that's higher than the IPO price, is just it's baffling, and sort of it's probably a mark against them in my book.
Graham, how do you read this buyback?
Yeah, I see it as a big red flag. I think that managements that do these kind of games are, if it's doing what Nick thinks in that it's all just for show, then I think that's a mark against them. And if it actually buys the stock, then it's buying it at a inflated price when it just raised the money recently. And if you're buying high and selling low, that doesn't work for companies any more than it does for investors. So I think that it's a black mark against them as well.
And the other thing here is it's not like they don't have other uses for this cash. And I guess the cash flow they're getting from the current business can support their rollout, but they have this massive rollout opportunity, and they could maybe even try to accelerate that with the proceeds here if they think they can. But instead, they're potentially playing these games. I think they might be playing a game, but we'll find out soon.
Okay. What about the US rollout? I mean, I suppose a lot of the upside in this business is based on the idea that they can roll out successfully in the US. It seems to be crazy that an Australian-based and originated Mexican food chain would be able to do what any number of attempts in the US where there's a big Mexican population and a big love for Mexican food. It seems like a very, very competitive environment in which to go. Why does GYG think they can succeed over there?
Again, your guess is as good as mine. I think this is another big red flag. So I think they've got about maybe 5 stores, mainly in the Chicago area of Illinois, and I think this is a bit of a pipe dream to suggest that they can roll out and beat the likes of Chipotle, but also all these sort of local and state-based chains as well that might have 30 or 40 stores. I think it's just bananas, to be honest. And they're burning cash. I think it's maybe $5 or $10 million a year, something to that, in that sort of regard. And it's puzzling. And the other thing here is they've got a master franchise agreement in Singapore and I think in Japan, and they're actually rolling out stores, and that looks like it's working. Like, I don't know why they didn't, or why they don't just double down on sort of an Asian expansion, which seems to be going okay. Instead, they want to sort of conquer the US, and I think it's a poor decision, and I'd be much more interested in the stock if they decide to exit the US, actually.
Yeah, I feel the same way about this as I do Xero. I think Xero made a big mistake going into the US and annoying Quicken, the owners of Quicken. Had they just stayed in Europe and focused their efforts on the UK and other English-speaking markets, or maybe even European markets, they probably would be in a better place than where they are now, where they've blown a lot of money trying to penetrate the US market, which is so much more competitive, so much more ruthless than any market any Australian company has probably experienced. I just think it's a very, very long stretch. Graham, you live in North America. What's your view on Australian companies going into the US?
I thought you were going to ask me about my experience with tacos.
What's your experience with tacos?
I think they should move to Canada. There's not enough Mexican restaurants in Vancouver. But that's just me. But I don't know. I think the US doesn't strike me as a crazy place to go. Maybe not to the same extent as, I don't know. To me, Asia sounds like, maybe I'm just burned by Domino's experience, and I feel like an Australian company selling burritos to the Japanese doesn't sound like a winning combo. But in the US, at least there is demand for this product, and I think going up against Chipotle is tricky, but they do have a bit of a different model in terms of store footprints, what's on the menu and all of that. So I don't know. I wouldn't write the US off just yet, but I think they should focus on their homeland first. Okay,
well, we don't have a formal recommendation on Guzman. We probably won't for a while unless the stock price gets a lot cheaper and this issue over the buyback becomes a little bit clearer. It does seem to be a red flag. Okay, let's move on to our final topic. There's so much talk about AI now. Everybody seems to think it's a bubble, which makes me wonder whether it is a bubble, and everybody's talking about the fact it's a bubble. But it does make investing difficult right now because almost everything is expensive. If you're an investor who is worried about pricing, is worried about values, worried about the parallels that people are drawing with the dot-com bubble, and you were looking to put your money somewhere other than term deposits and very safe bets, are there any cheap sectors on the ASX where we should be looking? Nick, you have a go with that first.
Oh, on the ASX cheap sectors, broadly I would say probably the only one that comes to mind is healthcare, and I'm not across mining enough to offer an opinion there, but healthcare looks pretty cheap to me. Obviously, CSL's fallen, but even like ResMed, even though it's gone up a little bit, still looks attractively priced. It's sort of 20 times, a bit over 20 times earnings. I know Sonic's fallen as well, and that's I think we've currently got a positive recommendation on that as well. But the ASX doesn't look broadly cheap. And what I find interesting about the ASX is actually some of the sectors that have performed really well that aren't performing really well overseas. And one of those is actually software. That's really led the market higher. in Australia. But in the US, while semiconductors and the Mag 7 stocks have done quite well, the software basket, sort of that next step down, has really been under a lot of pressure. So companies like Salesforce, Constellation Software, Workday, and even a business like Atlassian, a lot of these companies, their share prices haven't gone anywhere in 5 years, which is quite amazing considering the bull run we've been on. Whereas if you contrast that to the Australian software companies, they're all at or near record highs. And so, it's hard for me to find an actual sector that is really cheap. And unfortunately, I think locally, some of the sectors that have suffered offshore, haven't. And so there hasn't been as many opportunities to sort of, spot.
Yeah, I'm sure if Gaurav were here, he would argue that there are resources stocks that are cheap right now. Unfortunately, he's not, because he's moving today, and I think on Monday night or Monday day, he got bitten by an electrician's dog and spent the night in hospital, but he's recovering now and currently lugging a sofa out of the house into the back of a truck. Graham, what's your view? What sectors do you think, apart from healthcare? And I realise I should have asked you that question first.
Well, I agree with Nick. I think healthcare is, it does look interesting. It's also probably less likely to be affected in at least the near term by AI. I think over the long term, it could be a tailwind for the industry. There's lots of stuff that it can utilize AI for in terms of improving research, improving efficiency, all of those sort of things. But outside of healthcare, I'd probably be looking towards consumer staple stocks. We've kind of gone through a period where there's a very high cost of living. People have reduced their spending on discretionary items and also just cut back on all sorts of luxuries like food. So maybe, the consumer staples, things like Woolworths and Endeavour still look interesting to me. They're not going to be disrupted by AI either. So you can at least not worry about that risk so much.
Right. Okay, well, look, I think we'll leave it there, but I will say that we have 3 stocks on our buy list in healthcare sector now. One of them, Graham and I did a deep dive on a couple of weeks ago. It's an hour-long deep dive into one of these healthcare stocks that we think does offer good value right now. It's available to members only. So if you would like to listen to that, you'll need to join up at intelligentinvestor.com.au. And next week, we'll be recording another deep dive on a resources stock with Gaurav after he's recovered on a very, what we feel is a very cheap resources company in Australia. So if you do want to listen to those, find out more about those companies, sign up at intelligentinvestor.com.au. Nick, thank you very much for your time. Graham, thank you too. We'll be back in 2 weeks.